Welcome, everyone, to tonight's Sunday macro wrap up for Sunday, November 30th, the last day of November, and the last Sunday of November as well. So, pretty much over the past week, we were talking about this no landing stop go cycle, which I have the graph here right in front of you. This is pretty much what we've been doing since 2023. And, this cycle has proven to be actually an environment where the market can continue going up on a sustained basis. But it's what ends this cycle, which is going to determine either, a parabolic rise to a, new, major bull market, or if we have a correction here. And so, what's really going to matter is what ends this stop go cycle. And I think that what we're seeing right now is just another iteration, which is kind of good news for some of the riskier assets that we like to own. And really, over the past week with the Thanksgiving holiday week, it was extremely low volume. It provided a great opportunity on a bounce in order to get rid of a lot of losers that have potentially lost trend in the portfolio. Or if you had bullish assets that you had bought the previous week, well, you could have sold some in order to raise some cash for this week when we have volume come back, regular trading volume, as well as we get a bunch of new economic data, specifically PCE inflation on Friday, which we haven't had in a couple months due to the government shutdown. And we also have some major private data with ISM manufacturing and services PMIs, which we'll get into here in a second. But this week is going to be volume coming back. And so it's really important to see what happens on this volume, with volume coming back. And so that's what we'll be taking a look at here this evening. For those who are new here, joining us on Instagram as well as on TikTok, the way that these Sunday macro wrap-ups work is that they're an hour long, and for the first 30 minutes, we stream them live on our social media accounts. And then the second 30 to 45 minutes is offline just for our Macro Optics members. And so if you guys would like to learn more about how to gain access to our community, you can just go to the link in the description below, and you can check out how to go through with an application there. But let's go ahead and get into it here. So we'll get into some of the macro data, the key macro data that we saw last week. But, well, actually, let me go back to this diagram here. So what happened recently was we started to get some lower inflation expectations, which allowed us to go back into this potentially a go phase. And what this will mean is, is the market about to have another leg up throughout this stop go cycle? And so typically whenever we enter back into a go phase, this is when there is expectations of rate cuts, a dovish Fed. The stock market tends to rally on that because it's pricing in more of a soft landing narrative. And then because of that, a lot of optimism starts to come back into the markets, and then you have new all-time highs. And so taking a look at the S&P 500 rebound last week, we did go bearish for about a day, but then, it had a pretty aggressive rebound all the way back to bullish trend. So yeah, it did go bearish on 11/20, which was, I believe it was last or 2 Thursdays ago, right? Yeah, so that was Thursday the 20th. And then after that, it pretty much had a bounce, but it was all on low volume. So if we take a look and bring up volume here, you can see that on this bounce, look what volume did. It completely dropped off. And then as well, there was also a CME futures, I think it was an outage. Yeah, let me see here. Yeah, so there was a decent outage for the CME futures markets. And so for about an hour or so, there was no trading on the futures market, which was a little bit strange. But that was another contributor to the loss of volume there. And so really, there was a lot of optimism coming out of this week, but you really don't know if it's actual volume coming back until or we don't actually know if this is a sustained bounce until we have volume come back. And when you just look at the technicals, whenever you see a price bounce on low volume, that's called the bearish divergence, which anytime you have a bearish divergence, those are optimal places to take profits or just get rid of losers. And there wasn't really that many opportunities at the low end of the trading range, meaning dips in the market. There were a couple, one being the dollar, but there really wasn't much. It was mainly just a bounce from all the things that have sold off over the past couple weeks. And that was really the major opportunity last week, right? Raise some cash before Black Friday shopping. It was classic Wall Street right there. So that's pretty much the summary. And so coming into this week with a little bit of raised cash is what you want to be at. Now, obviously, we don't know the future, but volume is going to come back. And if this has a price decline on that, then that would be what would interest myself and my team, so that we can then use some of the cash that we rose over the past week in order to redeploy that into assets that have maintained their bullish trend and are now providing an opportunity to buy some more. So that's what this week is going to be all about, which is looking for new opportunities. Getting into some of the macro data last week, we saw that initial jobless claims finally came back, and we got the updated number here, and it did fall to the lowest in 9 months. So this is initial jobless claims, which could technically be viewed as a positive sign for the labor market. As we know, the whole reason why the Fed was wanting to cut rates in the first place was because of labor market weakness. And so if we're seeing jobless claims come down, that could be some beginning signs of a stabilizing labor market that has been going down. But then when you take a look at continued jobless claims, those have continued to accelerate. So the bleeding may have stopped with initial jobless claims, but there's still a lot of people who have filed for initial jobless claims and are circulating within that system. So these are people who, every single week after that 4-week period, they continuously are filing for unemployment and trying to get benefits from the government. So as you can see, that's pretty much been on a steady uptrend here. And that's one thing that's going to keep pushing up the unemployment rate. And then also too, we got a bunch of private data from the manufacturing sector showing a large deceleration for private businesses, such as the Texas Fed Manufacturing Index. That came down. We also got the Richmond Fed service sector that also contracted, but not that much. This is the manufacturing index for the Richmond Fed that also came down. Dallas Fed services declined slightly. And so we over the large amount of private data that was coming out last week, we saw a general decline. But this is a little bit different from the acceleration that we see in some of the leading economic indicators from the price charts. And so we're getting a little bit of it is a slowing economy, but it's not completely dropping off, which can be viewed as somewhat stable, but there is still a slower drop off happening. Now, in terms of producer price index, so this is the first time that we got PPI in a couple months since the government shutdown, and the PPI number actually came down a lot for the month of September. And so with this being looked at as a forward-looking inflation or CPI indicator, the market was taking this with a lot of optimism. And so this is core producer prices that came down, decently. And then you also had a decent acceleration or a continued acceleration in the services PMI according to the S&P Global. So remember that the United States is mainly a services economy. 70% of all consumption is through services. And so, even with a bunch of manufacturing numbers coming in low, it really doesn't matter as much as the services economy in the United States. It's part of the reason why you started to get, or we continue to get, pretty bad manufacturing numbers all throughout 2023 till now. And it really hasn't been too much of an effect on the overall stock performance. And so really looking at the aggregate economy with services, that has pretty much had a recovery from earlier this year. And so with services having a rebound, that is showing that the economy is somewhat staying resilient, but again, it's definitely weaker than it was. But yeah, so that's what we're seeing here in terms of the private data. Now, in terms of what we're looking at this week, again, tomorrow we get the ISM Manufacturing PMI, which is the leading manufacturing PMI. We'll probably see either more of a contraction on that front. The real one is on Wednesday, which is the services PMI, as well as prices. So that's on Wednesday. Fed Chair Jerome Powell actually speaks tomorrow night at 8 p.m. at some conference. You can find the link on the Fed website there. I don't think it's going to be anything major. I think he's just doing some introductions. I don't think he's the keynote speaker, but still, it might be worth watching. I won't be streaming that one though. And then, yeah, this week we get JOLTS numbers on Tuesday. We get the ADP non-farm payrolls on Wednesday. And then we also get the PCE number on Friday, which will be the PCE prices index is really the main one that the Fed looks at in terms of inflation. And so that's going to be the key component and probably the biggest macro catalyst this week, which is on Friday. On Friday morning there. So that is pretty much the schedule for this week. There isn't that much of, crazy data drops, but all of them are pretty heavy. So that's what we're going to be looking at here this week. And then also the big one is that the Fed rate cut expectations for the December 10th meeting had a flip to the other side. And so just in a couple weeks, we went from nearly a 70% chance of a pause down to less than 14% chance of a pause. And we went from a 30% chance to an 86% chance of a cut. So now there's more chances of rate cuts heading into 2026 than not. And initially, what the market is going to be doing is looking at this as more progress towards a soft landing as we continue to get some of those inflation readings coming down as well. What the market is really looking for is a stable growth environment as well as inflation coming down. That's more what's called a Goldilocks type of environment, which is something that will allow a quote unquote soft landing, because that's where the Fed can continue to slowly reduce interest rates as we get inflation coming back down to their 2% target without anything breaking in the markets. And this has happened before in the past, namely in 1993, I believe, or 1992. And then, or no, that was 1996, I believe, that they achieved a soft landing. And I believe it happened again in the 60s. But yes, I mean, it is possible. It's just not the most probable outcome. So they might be able to do it here. We'll see. We will see what time has to say about that as we go forward. But yeah, from here, it does look like there's a pretty high chance that we're going yet another round of this no landing stop go cycle with heading into this go phase. But again, just like any one of these cycles, you really need to own the most bullish trends and not own the most bearish trends or things that have broken trend. And so, we want to make sure that we are able to spot those, which is what my team and I do for our members. But the main bullish trend that we've been tracking over the past few weeks has been the dollar, which it has lost a little bit of momentum here in terms of its price action. But this is one of the reasons why the market has been struggling a little bit, or at least seeming like it's losing trend, is because of a strong dollar. Typically, when the dollar strengthens like this, it is a sign of a tightening financial market. But even with this strong dollar, we are just not seeing any type of strain in the credit markets. And so, when taking a look at things like the high yield spreads or credit spreads, we can see that this is still elevated from its lows here, but it isn't nearly at the levels where it was, back during the bear market of 2022 or even, during that scare that happened earlier this year with the tariff tantrum. So we're not seeing spikes like that, but we did see a little bit of a jump. But yeah, I mean, it's not looking like there's any type of major credit stress currently. That could change, but looks like it's okay for right now. Also, as well, when we take a look at bond volatility, we look at the MOVE index. So this is like the VIX, but for bonds. And as you can see, bond volatility, although it had a little bit of a crazy, whipsaw over the past couple weeks, it is still maintaining its bearish trend here. And so, with any time looking at volatility, if you have bearish volatility for an underlying asset, that's actually positive for the underlying price of that asset. So volatility going down is good for prices. So we continue to see bond volatility decline, as well as with the VIX, the volatility index of the S&P 500 here. That has been completely crushed from where it peaked out at on 11/20 here on November 20th. And so if this continues to decline, that will be more of an environment for stocks to go higher as well. And so really the key message here is we're still seeing continued resilience in the market. We had a little bit of a hiccup over the past couple weeks, but it seems like things might be contained here. But that doesn't mean that you automatically want to FOMO in and just jump back into the market. You have to be strategic as well as deploy capital on the next bounce here. And so again, in terms of the VIX, what we're looking for this week is an opportunity to possibly put that raised money into things that are going to have a bit of a correction if volume comes back. And so, maybe we see volatility spike up to 19 before, heading lower. We want to start to add to things that are in bullish trend and meeting the low end of the trading range during this possibly next spike in volatility, as long as it closes below that 20 mark in the VIX. And so that's kind of what I'm going to be looking for this week. We may not even get that this week. We could be getting more of the same where, volume continues to be somewhat lower than average, even if it does have a little bit of a pop back. If it's still lower than average, that could still be, that could still cause a little bit more of this, squeeze to happen. But I do think as well, the combination of the low volume as well as just a ton of people going bearish and short right at the wrong time is what also might be contributing to this squeeze here. So yeah, I mean, volume is definitely going to come back here, and it all just depends on what price does on that volume return to average. So that's pretty much all I'm seeing here in terms of the setup for this week. And so, yeah, with all the fear that's out there, I really am not seeing a major, major warning signs in the market currently. But yeah, I mean, there's still tons of opportunities. And as you guys can see with the bookshelf color in the background, the S&P 500 is in bullish trend. It did go bearish briefly and then went back to neutral pretty quickly and is now back to bullish trend. So all of those things are definitely worth considering heading into this next week. Broadcom had probably the biggest acceleration last week of the Magnificent Seven. Pretty large jump there, as well as Berkshire, which is pretty interesting considering Berkshire is a little bit more of a risk-off type of asset. They have a lot of cash, a lot of bonds, but bonds are looking like they are reverting back into a bullish trend after having a bounce over the past couple weeks. So cash and cash equivalents should be doing pretty well alongside some of the major Mag 7 stocks that have the best trends, such as Google. Google right now, out of the top 10 stocks or out of the Mag 7 stocks, is the best performer. But right now it's at the top end of the trading range, so this isn't necessarily a buying point. You would still want to see this have a bit of a correction, which it looks like it might here this week. But if this does give an opportunity on a dip for Google this week, that's one of them that that will be first on my list of buying there. The best trending sector still right now currently is healthcare. So the healthcare sector is, the best performer. And then I think the worst performer still, even though it's had a bit of a pop here and I think it's actually back to a neutral trend, is consumer staples, which is pretty interesting. For those who have been viewing this channel for a little while, you guys know that we track this ratio right here, which is consumer discretionary versus staples ETF ratio. And as you can see, this did break to bearish trend here. And so that is more so signaling a potential transition into more of a risk off type of environment, but it's not a broad risk off environment, meaning, just go all in on bonds and dollars and that's it. We are definitely seeing a trend shift happen right now, but it could just be a concentration into just a select handful of things that are going to do well here going into 2026. So that is what I'm seeing there on the major indexes as well as the major Mag 7 stocks. Taking a look at net central bank liquidity here, it did have a decent bounce since the beginning of November. It had a decent bounce to nearly 2 trillion. Still pretty low and in a bearish trend there. So net central bank liquidity is still a risk that's not off the table. There's still, plenty of other risks as well. So it's not like, the market is stable and we should just go all in on stocks. No, there's still plenty of risks out there. You just want to be able to own the less risky of them all. Probably the most risky right now, which is still in a bearish trend, is Bitcoin. So, Bitcoin having a little bit of a rough Sunday here. Or I guess it's right now, it's after 8 p.m., so it's technically in its Monday session. And it's having a little bit of a sell-off here. So, same thing with Bitcoin last week. It was a pretty big volume drop-off week. And so if volume comes back and it made a lower high right here, it shouldn't be surprising if Bitcoin, goes down even lower. So Bitcoin remains in bearish trend, which is also a big macro signal for slowing growth and inflation. So as well as, tighter financial market liquidity conditions. And so again, the risks, I would be pretty cautious to say if this is a start of the next bull rally. I know that's what the title of this video is, but for me, the answer is it's probably going to be less of a bull rally, right? It's going to be more concentrated into a fewer select things that do well in these transition periods. So yeah, Bitcoin as well as cryptocurrencies may continue to struggle after its bounce last week. So hopefully you guys were able to risk manage that and get rid of some Bitcoin on that bounce there if you guys were bag holding it. On the other hand, looking at actual physical stores of value, gold continues its bullish trend. Silver, even better than gold, new all-time highs. Wait, is this new all-time highs for silver? I think it is, yeah. Yeah, so silver's just absolutely crushing it. Beating gold. Let's take a look at the silver to gold ratio here. Yeah, you can see that silver has pretty much been beating gold ever since it went bullish versus this in mid-June of this year. And pretty much since mid-June, silver has been a way better winner versus gold in terms of the precious metal space. Platinum is also making a decent spike move upward. The ETF that my team and I like to use for platinum is PPLT. Let's see here. Uranium is bearish, so not really looking at that one. And then palladium, which is also another industrial / precious metal. That one could be having a breakout here as well after a period of consolidation. What else here? Yeah. Copper as well, which is interesting because copper is typically a signal of growth. And so with copper having a rebound here, that is pretty interesting. it's been trying to test this $32.30 area three or two other times. So we'll see if it has a rejection here again, or it could have a breakout. Either way, I'm not buying it right here. I want to see what happens at the start of the week here with copper as it closed above the top end of the trading range last week. So yeah, that's pretty much what I'm seeing here. Again, for those of you who are joining the call a little bit later here, and I'm going to keep repeating myself, but last week was a great time to take some profits and get rid of losers and get ready for this week with a lot of key macro data coming up, as well as volume coming back into the equation here. So we'll see what happens here in December. I know a lot of people like to sling around the word Santa rally during this time of the year. So my team and I personally hate those narratives because they do nothing but destroy portfolios. As we saw, we had an example of that this year with Uptober. We all know what happened there. And so you just got to be really careful with seasonality, because seasonality doesn't really mean anything. It could give some insight, but really, anything can happen, right? You should never base your investment strategy entirely based off of seasonality or what typically is supposed to happen, because that's just going to get you into trouble. Again, as we saw during Uptober. So yeah, beware of the quote unquote Santa rally. Not saying it's not possible, but what we want to do is make sure that we are looking at bullish trends that are in fact having a Santa rally already, or have been all year, which are some of the things that we've been talking about on this call. And so that's pretty much what I have for you guys here. Yeah, and that's about it. The big news next week is going to be PCE on Friday. But yeah, let me know what you guys think in the comments below, if we are heading into an official go period, or if we might be heading into some type of fake out. But we are coming up here on 8:30. We're going to go ahead and sign off of the streams, but we're going to go into part 2 offline here for our Macro Optics members, where we are going to get a little bit more in detail of what we just reviewed, go into questions, as well as review some of the different key tickers that my team and I are looking at here this week specifically. So again, if you guys would like to learn more about that, just go to the link in my bio and schedule a call with me, and we can talk about the community there. But I appreciate everyone for joining. Zoom people stick around even more, and we'll say bye to YouTube, as well as Instagram and TikTok. Have a great week, everyone.